Nigeria just hit the refresh button on its economy with the rebasing of the gross domestic product using 2019 as the new base year. First quarter data shows a 3.13% year-on-year growth, putting nominal GDP at 94.05 trillion naira for the full year of 2024. GDP climbed 3.4% to 372.8 trillion naira. One key shift, the debt to GDP ratio eased to 39.4% in the fourth quarter, thanks to the larger economic base. But beyond the numbers, what does this mean for the real economy and the path to stability for Nigeria? Joining me to unpack this story, we have Tilewa Adebajo, the CEO of CFG Advisory, and Charlie Robertson, the time-traveling economist. Thank you so much for your time, gentlemen. Tilewa, let me start with you. And as we look at the new numbers here, we're seeing a refresh on growth. And speak to your first take on the GDP figures when it came out.
Well, I think the GDP figures when they came out was not much of a surprise in the sense that a lot of the things we'd seen before in terms of the growth of the Nigerian economy was that the GDP trajectory was on the decline. Our GDP was close to 600 billion about 3 years ago. And with the devaluation, extensive devaluation, which occurred in the last 2 years, it was clear that our GDP figures would not exceed around the 200 billion mark. So when the rebase numbers came out, I think it wasn't really too much of a surprise. But at least we've done that exercise. And we now have a new base figure of 2019. And I think we'll work with that. But I think the growth figures, I think, reveals a more important story. Fourth quarter GDP was 3.8%. First quarter GDP is 3.1%. So the GDP growth is actually on the decline. And that's really a source of concern.
All right, let me bring in Charlie here. Charlie, your take on the numbers. Are we seeing real growth here, or is it just a play on numbers?
I mean, firstly, I like the fact that the rebasing wasn't what we saw in 2014. 2014, it was nearly 100% increase. And the great pride was taken in the size of the economy being the biggest in Africa, but it didn't reflect the ability of the government to collect taxes. It didn't improve revenues. This rise of 30% was eminently realistic. I mean, the way I think about it is per person. And in Nigeria, the official figures until last week were the per capita GDP was $800 in Nigeria. Now, I know the currency got hit incredibly hard last year, but that was not realistic. And we're now at $1,100, which is much closer to Tanzania, Uganda, the sort of peer group that Nigeria's average per capita GDP is at. So I think we've got much more realistic numbers now. And I think that's helpful. I think the 800 figure we had before was just way too low.
All right, because numbers are good for policy making. You know, we plan to have these data sets coming from time to time to aid planning there. But in terms of policy response, looking at what was in play out, we just saw the MPC make a decision on interest rates just yesterday. I'd love to get your take on what this means going forward for policymakers.
Well, I think what's important is the fact that macroeconomic reforms and stability, I think we all have the consensus that we have some level of economic stability right now after 2 years of reforms. But after 2 years of reforms and economic stability, that's not enough. You know, that by itself is not enough. You need to grow the economy. An economy of 200 million people with Nigerians has to grow at least at 8 to 10% on a sustainable basis for you to lift people out of poverty. Even the GDP numbers you're talking about at 1,000 is very disappointing for a country like Nigeria. The high of our GDP per capita was about $3,200 about 12 years ago. Now, considering the devaluation of all that, what it means is the fact that you've impoverished Nigerians. More importantly, also, we're dealing with a strong inflationary environment. And the central bank is trying to go through an orthodox monetary policy to be able to go through some disinflation. There are still challenges, and as you can see, the central bank and the monetary policy are not yet confident enough to begin to cut rates to be able to stimulate growth. So until we tackle inflation, we cannot begin to address the issues of growth and the structural reforms that are necessary to stimulate growth to the levels that are sustainable for the size of our economy.
Charlie, your take there on the sort of policy response we need to be making here in Nigeria, and then when you look at the target that we have, with the government is trying to get to a $1 trillion economy, what sort of shifts do you think we need to make to achieve that?
I think they've done the biggest shifts. They inherited a terrible mess on the currency side in 2023 that should not be blamed on this administration. They've freed up the currency. They've got rid of the fuel subsidy. These are two of the most important reforms. The consequence of that has been a spike of inflation. That is coming down, but slowly. It takes time, and the central bank can't cut rates. So right now we've got no credit growth, 4% year on year. Inflation's running at over 20. So in real terms, we've got negative credit growth. We've got the oil price at $70 versus $140 in today's money 10 years ago. So the oil price has slumped. There's no credit growth. People don't go out and borrow when interest rates are in the 20% to 30% kind of range. But going into next year, if inflation's down sub 20% by the end of this year, interest rates have already been cut later this year. Oil production's on the rise, around 1.8 million barrels a day. That's off the lows of 0.9 million barrels a couple of years ago. There is progress. There will be a payoff. But the one thing that would really make a difference is the oil price going back to $100. And the Saudis aren't going to let that happen before the midterms, in my view.
Yeah, because Charlie brought in something that I really wanted us to talk about here, and I'll get back to you on the same topic. It's the global environment and the uncertainty we're seeing play out there. And we've long talked about how Nigeria should be aligning fiscal and trade policies going forward. But looking at now this clear picture that we have on the GDP, how then do we move along?
Well, as far as I'm concerned, I think oil prices should be a non-issue for a country like Nigeria. Most of the strong oil-producing nations like Norway, UAE, and Saudi Arabia all have significant sovereign wealth funds that help them cushion the impact of volatile oil prices. In Nigeria, there was a time we had about close to $20 billion in our excess crude account. That account now sits at about less than $500,000, a paltry sum for the size of our economy. And therein lies the problem of Nigeria in terms of our fiscal challenges. Our debt levels, I think, are still sustainable, but not for very long, because I think we're hitting that debt ceiling, especially with the borrowing plan you announced earlier in the program. So I think what is important for the Nigerian economy now is that you need to, while you're waiting for these, for inflation to come down, and you're waiting for a lot of cuts in rates to stimulate growth, you now need to begin to implement your structural reforms. You need to begin to put in place policies that will drive growth. You need to review your industrial policy. You need to review your investment policy, even your trade policy in line with the Trump tariffs, and understand that you need to synchronize this with your fiscal policy and your monetary policy to begin to prepare for growth. You can see now that Dangote recently announced that he's now going to build an LNG plant in Olokola and also Deep Sea Port. We need more projects like that. LNG Train 7 needs to be completed. That's a $9 billion project. And we need to see more investment in the oil and gas sector. As you can see, the oil and gas sector investments was a high of about 25 billion about 6-7 years ago. That dropped to less than $1 billion a year. So now with the reforms in that oil industry, we're beginning to see more investment coming in. So we need to restore investments into the economy now to begin to stimulate growth.
Okay, let me get Charlie's take on this now. One, on the policy alignment we need to see in terms of fiscal, monetary, and trade, and also what are the next steps for the reform trajectory?
I think your other panelist is also quite right on this issue of it's going to be private sector investment. I think the government knows that it can't afford to make much of a difference itself. It's the interest burden is big, and that's where a lot of budget revenues have to go. So it is going to be about the private sector. What's interesting about Dangote is he tends to avoid borrowing. So the interest rates, he tries to avoid borrowing. So the interest rates in 20-30% is less relevant to him. For that to widen out to more, the oil and gas story, it's true. They've been able to pick up assets off the global majors who've left. They are investing a bit more. I don't think there's, on the government side, it's about trying to keep that budget deficit contained, because every time the government's out there borrowing, then that's less money that's available for the private sector. And the more the government borrows, the higher interest rates will have to be, because there is not a great amount of savings in the Nigerian economy, and there won't be for some years to come. So cutting the budget deficit is probably the medium-term priority. Can that be done in 26, 27 with elections coming up? I'm not sure about that, but hopefully afterwards that will be one of the policy choices, along with privatization, trying to bring in, IPOing NNPC, for example, bringing in capital to help boost investment could be a very helpful way of giving the Nigerian economy a lift.
Charlie, I'd just love to stick with you a bit there and talk about the issue around debt sustainability, since you brought a part of that up there. Your take on what we're seeing play out there with the 39.4% debt to GDP ratio. Yes, we're seeing a wider economy, but what sort of fiscal space does it give for Nigeria in terms of borrowing?
Look, I mean, I've spent enough time with fund managers over the years to know that they do look at the headline figure of debt to GDP. And that's gone down with the rebasing. It's gone down from 55 or so down to 40% of GDP, which sounds good and will encourage people to feel more comfortable lending to Nigeria. But the metric that I've been paying attention to, basically since the last rebasing in 2014, because it gave a misleading picture on debt to GDP, is debt to revenues. And that hasn't changed at all with the rebasing. Revenues are still the same. The absolute nominal level of debt's the same. The ratio is the same. It's about 3.5 times, 350, 360%. That's not terrifying. 500 plus, where Senegal is, that's frightening. 400, risky. Just under 400, like Nigeria now, is quite good, relatively, but it doesn't give us much room to weather shocks, like the oil price dropping into the 50s, or a big spike in global rates. I mean, there's a number of issues that could still be problematic. So Nigeria has to be careful on cutting the budget deficits. The safest way for this economy to...
Tilewa, he mentioned something very critical, not to focus on debt to GDP, but more or less looking at what we're seeing in terms of debt to revenue. And I'd love to get your take on that, especially with the fact that what we've seen in terms of what the government has done in terms of trying to raise revenues for the budget this time around, and also the tax reforms that have come in place.
Well, I think we need to move beyond policy to understanding that we need to grow this economy. There's an impact. We need to put a human face to what's going on. Living in Nigeria the last 2 years has been extremely difficult. And I think that the government needs to be able to put in policies that will create succor for the people. And one of the ways they can do that is the fact that it is clear that the budgets that the government puts forward, they can't finance their budgets. So the government has to change its budgetary expectations. I think that's very clear. While we have this issue of debt sustainability and manageable debt to revenue ratios, tax reform is good, but I think the results, will not see that till another 2 or 3 years. But what is important for me is the fact that the federal government of Nigeria needs to restructure its balance sheet. And like I've said, they need to sell down JV assets in the oil and gas industry, raise about $40 to $50 billion, and restructure their capital structure and put more equity into the capital structure of government. So once that has been done, I think we can now create a path to sustainability, which will bring down inflation and improve purchasing power of Nigerians and give Nigerians a more balanced lifestyle. That is really, I think, the concern right now.
Yeah, because Tilewa just touched on something very important here, translating GDP into real value for Nigerians. And I'd love to get your comment on that, Charles, as we wrap up the conversation, looking at what we're seeing in terms of the cost of living and disposable income of Nigerians. And if you do a comparison from 2014, like you rightly said earlier, to 2025, what are these disparities we're seeing and how can we fix that?
Well, from the data we're seeing on the inflation front, life is not getting worse anymore. Inflation month on month has been pretty decent. Is there anything the government can do to make it a little bit easier? Perhaps cut a few tariffs. I realise that's not the trendy thing to do in the world economy today, but perhaps cut a few tariffs on food imports could make a bit of a difference. But I think the best thing that the government, the authorities can do is provide a more stable environment. And after the shocks of 23, 24, that's what we now have. It's a much more credible policy-making environment, and that lets people start to plan ahead. Now, 3 years ago, you couldn't invest in Nigeria as a foreigner because you couldn't get your money out. If you can't invest for the long term, you don't pay attention to the economy. You don't create jobs. This this can now change. And that's such an important change that we've seen in the last 2 years.
All right, thank you so much for your time today. Charlie Rebasing there, the time-traveling economist, and my guest in studio here, Tilewa Adebajo, the CEO of CFG Advisory.